Hey, what's up, guys? So today I wanted to make another video. So lately I've been getting a lot of clients wanting to purchase a home, and we've been, putting them through the pre-approval process. But for whatever reason, there are always these common issues that I'm seeing that are preventing people on buying their dream home. And today I want to go over the four most common that I'm seeing that's preventing them and offering solutions to each one. So I hope that you guys like it. The first two are kind of go hand in hand, and I'll show you why. This is going to be income and debt. So check this out. Okay, so to understand the relationship between debt and income, I decided to show you the formula that banks use to give you an idea of what you're going to qualify as for mortgage. It's actually called the debt to income ratio, right? So it's going to take your monthly gross income times 45%. This is the amount of debt percentage they want to see you to have. And it's going to depend on what bank you use and also what program you use. For instance, FHA is going to do 55, some might do 50, some might do 49%. Conventional usually does 45, but there's also ones that do 43. So just to stay conservative, I'm going to leave the debt to ratio to be 45%. And then you're going to subtract your monthly debt, and that will give you a good idea of what your mortgage payment will look like, right? So I ran two scenarios. One where the person is making less money but has less debt compared to another person who makes more money but more debt. So in this scenario, this guy makes 4,500 a month. Minus his debt would be he has a school payment of 175, a car of 125, and this would be the formula for him. So his estimated mortgage is going to be around 1725, right? Well, scenario two, well, he's actually making 2,000 more than this guy. However, he has two cars that he's paying for, three credit cards, and he decided to finance his jewelry. You want to get that chain. So because of that, he actually qualifies less because of all his debt. Also, when you pay off your credit cards on time every month, they typically won't count that when they're going to do your debt to income ratio. So if you pay off all your credit cards, they could take that out. With other credit cards, it's going to be your not your total amount that you owe, but your minimum balance that you need to pay every month. And with debt, it's not including things like subscriptions, insurance. They're looking for things that are installment payments, things that are require hard inquiry, that are going to stay and show on your credit report. Let's say you're not happy with your mortgage limit. You want to qualify for a little bit more. Well, on the income side of it, there are a couple options for you. For one, obviously, find a new job that pays more. That's pretty obvious. The next part is, investing in yourself, whether it be gaining skills, maybe a certificate, maybe a higher degree, so that you get promoted for a higher income, or maybe get a higher paying job. Kind of goes hand in hand with the first example, but that's always an option. The third option, which is what most often people do, is they go in on it with somebody else with the loan. So it's two people on the loan. It could be a partner, it could be a family member. It helps increase your purchasing power because now you have not just one income to go off of, but two. And then the other way is, getting a side hustle to increase your income. For that one, however, you're typically going to need two tax returns, 2 years of tax returns. For the debt part, the solutions for that is, start paying your credit cards on time. If you have a zero balances, they're not going to cover that minimum because they see that, oh, okay, this is a responsible borrower. We don't have to account for that. Also, if you have a hefty car payment, maybe paying it off until like the final 10 months. Banks will actually allow, depending on their program, of course, they will actually allow to exclude the car payment as debt if there's only 10 months left. Another part is just avoiding creating more debt for yourself. So, in that example with the second scenario, the person bought jewelry and financed it. So, it's kind of like know your priorities. See if buying a home is important for you, maybe don't spend so much and finance so much so that you're able to have a higher purchasing power. Another thing is just knowing your budget. So a lot of people, especially, with my age group, coming out of college, getting their first paycheck, their first real job, they want to get that nice car. I would say refrain from that and, buy something that you need for right now. And then obviously as your income increases over the years, as you get promoted and all, that's when you start, purchasing the things that you would like. um, Obviously it's going back to prioritizing, but that's another example of what you could do to be able to have a higher purchasing power. So keep in mind, for every $7 you have in debt, that's $1,000 that's taken away from your purchasing power. So for instance, $7 in credit card, let's say, for minimum payment, you're only say losing $1,000. But let's say it's 140 that's your minimum. Well, that's 20K, and that makes a difference. Now another reason what's preventing people from purchasing a home is their credit. So 580 can get you through the door. However, obviously the better your credit, the better terms you're going to get, right? Typically around 640 you'll start getting into programs for first time home buyers like IDA, where they help with closing costs, usually a lower rate. I would prefer going, if you're purchasing a home, to be over 640, but just know that you can at 580. So the quickest way in bettering your credit is taking your credit card balances and getting them to under 30% of the max amount given. That is going to help you tremendously and honestly be the quickest way of bettering your credit. Obviously, paying your bills on time and avoid having things go into collections. Once it gets into collections, it really starts ruining your credit. Avoid opening unnecessary accounts and also avoid closing long-term accounts. If you've had that account for a long time, how people look at your credit is how long you've had credit. So make sure that those long-term accounts you're actually keeping, that you're paying on time. Another thing is, if your credit score is getting really, really low, it might be time to get some help. It's kind of like getting a trainer for working out. You could get all this information online. It's free to you, right? But having somebody like a credit specialist will help you prioritize what's important and what will get your score lower, but also keep you accountable. Somebody to kind of, be in your ear and tell you, hey, you got to do this. It might be very beneficial for you to have. The next most common issue that I see is not enough money for down payment. Now, I would say the minimum you should have in reserves should be 3.5% down, because that's probably what you're going to be putting down as a down payment if you're using an FHA loan. If your credit's good enough, maybe you could do 3% on a conventional, but I'd say stick to that 3.5%. So when you have that, you could purchase the home and you can utilize things like seller credits or down payment assistance programs like IDA. However, you're going to put yourself at a disadvantage, right? Especially when you're coming up in this market where there's not a lot of homes, there's a lot of buyers, and there's multiple offers, because your offer is going to look less great when you're asking for seller credits than another that's not. So minimum I'd say 3.5%, but I would probably want to be around that 5 to 6% range on the home that you would like to purchase. So if you're buying a home that's 300,000, then try to save up at least about 5% of that price, right? And the best way to save is to learn how to budget, know your bills, know what you usually spend, and live below your means. Maybe get rid of that car that's costing so much. Start clearing off some of your debt. That's going to help you into saving, and then therefore you're going to have money to pay for the closing costs, pay for the down payment, and then finally achieve purchasing a home. Now, if you'd like me to go in depth with any of these, because obviously there are many things that I'm missing out for, just wanted to give you guys a little bit of insight, a little bit of solutions, and kind of give you guys a common objections that I've been seeing when people are purchasing a home. If you'd like to know more, please give me a call. I'll be more than happy to help.